Great. I think we'll get going with our panel here on the topic of valuations. Tough act to follow. We've just had a very good hour on the M&A theme. But what I'm going to do is lead the discussion. I'm very lucky to have a couple of people on the panel. I've got the easy job of just moderating. I'll let you know who I am for those of you who don't already know, and I'll have my two panelists introduce themselves because that's much easier than me doing it. So I'm Denzil Rankine. I'm the Executive Chairman of AMR International, and we're a strategy firm operating on both sides of the Atlantic, specializing in this industry as well as the events industry. Quite a lot of our work is around acquisition. We help people decide if they should be buying businesses, whether that's private equity or strategics, as well as growth strategy. I've written 5 books on the topic of acquisition. I did that because I had a chip on my shoulder because I didn't do very well at school, and I thought that would make me look clever.
Is there a book signing after this?
No, there is no book signing. That reduces the value of them.
You have to become a client to get a signed book.
That's right. Yeah, there you go. You got one.
I have.
One of those books is called Why Acquisitions Fail, and that's actually the one which I found the most interesting. And paying too much is only one of the reasons, one of the 20 reasons for failure. Anyway, that's a little bit about me. Why don't we just have an introduction from the two panelists, and then we're going to get stuck in. So, Bruce, do you want to go first?
Yes. Well, good afternoon. My name is Bruce Guzowski, and in getting ready for this presentation, I had to go back in my history and realize I've been doing M&A work for almost 35 years, the last 17 of which have been in the media space. I was the CFO and the eventual CEO of HC Pro, the company Dan Oswald referred to before. I bought the business in 2002 in a management buyout, and over the next 5 years executed over 25 transactions with that business, becoming one of the masters of doing tuck-in acquisitions to increase the size of the business, to buy new capabilities, to enter new market space, to bring in new talent, or to just get great underutilized customer lists. That business was sold in 2008, generating over $50 million of profit for the investors. It was a highly successful deal, worked out really well. Since then, I have done a number of things, but am now focused exclusively on the M&A side of life. I'm selling businesses for entrepreneurs. I'm selling non-core businesses for other companies. Brent made a great point earlier today in his keynote address about about focus, and that over a number of years you accumulate all these assets, and it's really time to find better homes for those assets. I'm also working on the sell side for a number of situations, including Dan Oswald, and I'm helping him find some transactions that are reasonably priced, and we're going through that.
Okay, that's a good intro. Jim, do you want to tell us a little bit about yourself?
Sure. Jim Casella. I started the current Asset International when we acquired in late 2008, early 2009, a company called Asset International, and it was a thesis roll-up that we did with Austin Ventures growth equity firm. And we started the company in 2007, and as the financial markets got really weak in late 2008, early 2009, we decided to buy, which, one of two things could have happened. People would have said we were the dumbest guys in the room to be buying when the smart money ran to the sidelines, or we were going to have a very good outcome because we didn't have much competition in 2009. The core business that we bought in 2009, actually, Scott and Wilma sold to a Strategic Insight, and that today is the core of our business. Some of you heard Jason Cassidy earlier this morning speaking. About 65% of our business is a data and analytics SaaS model business built around Strategic Insight, but then taken globally. And about 35% of that business is a marketing solutions business with the same clients, different parts of the house where we help them go to market. Austin was with us until really mid-June when we announced that it was time for their limited partners to get a return. We ran a full auction process, and we sold the company to Genstar Capital. And today, I think it was one of the two Dans mentioned that, or might have been Doug, your first 24 months, that's when you're very aggressive with a new PE owner in terms of buying, and we're aggressive buyers right now. Jason's been on the phone because we had 2 deals we're working on in Europe. Hopefully it'll go to LOI this week. So that's who we are. We think there's a lot of potential to continue rolling up this business globally.
And you did one or two things before that, for example, running Reed Business Information.
A couple of things before that in IDG, but I had decided it was a good time to kind of go out and do it in a slightly different environment than with the larger players. But I met Denzil at Reed, where he did a lot of work for us, and I can't tell, I was half joking about the book, but when you're backed by a private equity firm, limited partners really do want to see that you do your commercial due diligence. And on all the deals that we've done, AMR has actually been our partner in doing that due diligence. So gotten to know him really well post-Reed as well.
Yeah, no, that's true. So we're thinking about valuation and how to maximize the valuation of a deal. Now, we're not bankers, and so my definition of valuation is just what some damn fool's going to pay for a business. That seems to be what the value is. But let's get a bit more sophisticated and think about the factors which are going to input into that. So what about timing? Timing of the sale of a business. Is it really worth waiting for a cycle, or how should we look at timing when we're thinking about selling a business?
Well, obviously, obviously the cycles come and go. You know, right now we're at a peak of a cycle because there is so much, as they indicated in the previous session, there's so much cheap money out there, and multiples are allowing the private equity guys to pay 2007 or 2008 levels in terms of pricing, in terms of multiples now. And on the strategics, are paying some really interesting prices too. We just looked at a deal, a $20 million deal I knew very, very well, generating zero cash flow, and they're going to still get one-time sales from a strategic. So I think if you obviously you want to hit the cycles at their peak. So I would recommend that. So.
But Jim, then how did you manage to convince people to sell when the timing was off, in inverted commas, through your build-up?
That was interesting. I mean, if you owned a business in 2009, and all the businesses we bought, those 3 core businesses in 2009, were started by entrepreneurs. 2 of them were 20-some-odd-year-old businesses. One was, I believe, about 5 at that time. They were very afraid they were going to lose everything they had built. And they really obviously didn't want to lose everything. At the same time, they had a sense they wanted to keep their legacy. And who would take care of that? And I think, with Strategic Insight, which was the oldest of the businesses, Scott did a great job with that team, convincing them that we could be a buyer that they would be very comfortable with. So they took some money off the table. They rolled some money in, not very dissimilar from what we just did. But they have helped then with the next company by saying, you know what, Jim and this team that he's put together here, they're pretty good guys. And they're more interested in growing the business. They're not interested in coming in and telling you that you've done everything wrong. Although we did find a couple of them hadn't had a budget in 20 years. They didn't do things like that. Scott knows just what I'm talking about.
Just gets in the way.
But, we've made it comfortable. I think really, the time that I spent with Pat McGovern, who passed away this past spring, as his chief operating officer, was, where you learn a lot, where, it was a very decentralized model. You let the entrepreneur who's running that business and who's close to the market make decisions. We were there really to provide a structure, the resources. One of the businesses we bought, the trade in London during that time, John Lee, the founder, had sold 2 other businesses and wanted to sell me his business in February of 2009 and leave. And, I didn't have anybody in London. It was myself and 2 partners from Austin Ventures. And I was very clear I couldn't buy it without him staying. 5 years later, we've sold the business. He's re-upped, and investor. As he likes to say, it's the longest job he's ever had at this point. So there's some of that, understanding, what the entrepreneur needs to feel comfortable about. Will you take care of their legacy? How are their brands handled? And if you can get them to be on your side, as opposed to a lot of large strategics come in and say, the day you sign, you're gone. And in fact, my funniest experience with that was the gentleman in Australia, where he told me he was retiring, and it was 6 months into the deal. And Simon, I said, why would you do that? He said, well, the other person that was bidding on the company told me I had to. And I said, well, I never told you that. He said, oh, so you would keep me. So he's still with us 5 years later, and he does all the product development in the risk area for us. So I would have had a hard time replacing him.
So it sounds like we've got, from a timing point of view, we've got the financial timing, which is driven by interest rates, debt availability,
It's a very,
and so on.
very good time right now to be a seller, but I would argue that it's a good time to be a buyer as well.
And I agree. I think it's absolutely a good time to be a buyer. You do find entrepreneurial situations where they just hit a wall. And I used to, in the 200 competitors that HC Pro had, the competitors would either hit $1 million, $1.5 million, or $3 million, and they would stop. They would just not have the ability to invest in the marketing, invest in the technology, and they would just hit those walls. And you'd see them all the time. And when they hit the walls, they're realizing, oh, their competitors are going past them. So they know they have to do something.
Yeah. So it's a business logic. We've got the financial logic and the business logic. And what I'm picking up from Jim is saying that when the financial logic doesn't necessarily work, you can go with a business logic, you can go with a structure to actually make that a good time to buy a business.
If you have a partner, a private equity firm, which I did, many of them have the capability to buy all in equity during a downturn and eventually refinance, which is what we did a year after we bought Strategic Insight. If you have that capability, you have an advantage, really, in the market, because most of the strategics at that point had retreated to the sidelines. They're back today, but in a downturn. I would argue, though, as I said, I think today with interest rates being at historical lows, and I think they'll stay very low through the 2016 election, whether you're a buyer or seller, it's a very interesting time to get deals done. I think you can see it in the league charts and league tables in terms of deals that are getting done. It's really, I think, a unique time, probably the best time since 2007.
Absolutely.
I think that's right. And no one really knows how long it's going to last for, but it may be there's a couple of years linked, for example, to the election, or a view that we may have a year or two of this. So how long does it take to prepare for sale to get the maximum valuation? Is that something you can just do in a number of months, or is that something you have to do from day one? What sort of lead time and effort goes into thinking about sale and exit to get the maximum valuation?
Well, I think the whole sale process at least takes a year to think about, because you've got to start with, you've got to have audited financial statements. It's very important that you get your act together as a management team, that people underestimate the value or the importance of that management meeting with the seller. You run your standard process, and the investment banker sends all the books out, and you go do anywhere between 4 and 12 management meetings. Well, that management presentation you do to those potential sellers, where you're showing off the company and your management team, is absolutely critical. So you've got to get your management team together. You've got to get your financials together. You've got to get your systems together. You have to do, I'm probably missing a few things off the top of my head as to the importance of things that you have to do. I know when I bought HC Pro in the management buyout in 2002, I started thinking about selling that business the day I got back from the closing table of that sale. I started a data room the following day, because I knew the private equity was only going to be in there 5 years. It was actually 5 years and 3 months. But I knew that the thing was going to be sold again, and I just started thinking about it at that point. But if you haven't done it before, it really requires a year. You got to interview investment bankers. You got to make that selection. There's a whole series of things you have to do.
Yeah, I was more expecting the second point you were making around from the day you go into a business. That's when you have to start thinking. But you're not going to get an investment banker on that day. I'm thinking about the shape of the business and getting the right structure and the right business model. Jim, how did you look at this over that period? How much time were you spending thinking about exit?
Ours was really a thesis play from the beginning. We had looked at different sectors and then decided to do this roll-up in financial services with a focus on asset management. So we never really focused so much on when as whether or not our thesis and how we were building it. So one of the things that was core to that, we knew we wanted to be over 50% recurring revenue. So the type businesses we would look at in Australia, in Canada, for example, we've made acquisitions. Those are subscription-based businesses that built around that core. So we were more following that, and then how the clients fit together on the other side, on the marketing solutions. So Fidelity is our biggest client. They spend about $2 million a year with us, but about 1.2, 1.3 is subscription globally, And the balance is everything from events to digital advertising to advertising in print. So we had that model that we were building, and actually it was based around a model that Austin Ventures had done successfully with a company called Home Away that they took public. So they had a model in mind. I shared that vision of the model. So it was more how we built, and we kind of came to a sense when it would probably be time, given, you know, I think Bruce is absolutely right, and you heard it in the last panel, you know, somewhere between year 4 and 6, year 5 is usually when you get your best return, that you want to have the business really running on all cylinders at that point. And it does take that year to get ready, getting your team ready, and those management presentations are fairly tedious when you find yourself saying the same thing over and over. And sometimes you get a skeptic in the room about some of them things. So it's a time-consuming process. It does take you away from the market for a while, the client market, the customer market, because you're you know, doing that. So this has been a good time for us the last 2 months, really, you know, deciding for a 100-day plan what were the areas that we're going to invest in going forward. What are the growth areas? What are the ones that we don't see growing as much that, you know, will be there, but we're not going to make investments in them.
And how disciplined do you have to be during that whole period when someone comes into you with a bright idea that's not quite on strategy? How easy is it to say, no, that's not in the strategy, that's not going to get me maximum valuation, go away, versus trying to explore it?
What you really do is try to figure out which areas, even if in fact they're not one of those areas that's identified as your top, you know, top in the 100 days that you're going to focus on. One of your top ones, there were good ideas that come out. I'll give you an example of this, one that has some irony to it. But the early founder of Asset International, Charlie Ruffel, had an idea for a publication focused on asset owners. And during the process of buying his business, he wanted to know if I would invest in it. And I said yes. What I didn't tell him, I really was not interested in starting a print publication. And so when we closed, I said, Charlie, I want to do this, but we're just going to do it digital, and we'll do events. And he thought about it for a couple of days and said, okay. And we hired a young editor who was probably in his late 20s and put together what today is called Chief Investment Officer. It's actually our single fastest growing product. Now, it isn't in that, you know, recurring revenue space or anything, but, you know, this coming year it'll do over $5 million. About $2.5 to $3 million of that is actually in very high level events. And the balance of it, ironically, after about a year and a half, Kip McDaniel, the editor, came to me and said, there's a clamoring to have this in print. So about half the people, even though I swore I'd never launch another print publication again, half that 15,000 or so get it in print. And so I had to admit that I was wrong, and there is still a demand for print. And as I said, it's a great brand. We plan to create a data product that we're going to use that brand on for institutional data. So we've gotten a lot of mileage out of something that you might have looked at and said that wasn't in your core when you were doing it.
Okay, it's a good story. Yeah. Thinking again about maximizing value, what about scale? Can we just think about maybe some of the benchmarks of scale or how to look at scale? We've had a discussion about the transformative acquisition, whether that makes a difference. To what extent is scale on its own right going to maximize value?
Well, bigger is always better. You know, and I think there are points where you get more people interested in transactions. A $10 million EBITDA mark always attracts a new set of lenders and a new set of private equity firms. And you look at, you know, Abry Partners, which is a, you know, private equity firm in Boston, you know, at one point was doing, you know, fairly small transactions. Now they probably don't even touch a transaction unless it's $15 or $20 million of EBITDA. So, you know, you really do want to get yourself at a level where more people can play at. So that's how I view on scale.
Yeah, I would concur with that. I think particularly, and I know we have a number of lenders that are here at this conference, you know, the lenders below that $10 million market, they're less likely to look at a transaction. They will. There's some out there. But I think if you form a good relationship, in our case, year after we bought Strategic Insight and the others for all cash, we actually got some leverage put on the business with Goldman Sachs Specialty Lending Group. And they made it known during our sale process they really like our business. Their asset management group uses our product, and they have for 12 years. That was part of the due diligence that Denzil did. They said, you know, this is a great company. They actually raised their hand and said, you know, we want to stay with this business. So today, you know, we now have leverage of twice as much as we originally put on as a percentage on the business. Very different interest rate market. And, you know, they actually were the majority lender. They syndicated Alliance Bernstein and Tannenbaum are with us now as well. But it made it a very attractive thing for buyers to look at and say, gee, the lender who's been in this for 5 years wants to continue to do this. You know, it gave them a sense they knew the business and they know the cash flow profile of the business.
We need to open up and get a little bit of audience participation, but it's a great way to do that is to pick on someone. So Wilma, I'm going to pick on you. There's a deal. There's a deal that I know that you guys did where you took a couple of players who I think between them were 1 and 2 in the market, and you put those together and sold those to a single buyer. Is that an example of scale where you actually managed to get a better valuation for those 2 businesses, or did it just make that transaction happen for other reasons?
Well, we've actually done 2 of those transactions, and Scott and Sam Barthelme and a couple of other associates within our firm, because they're very hard to do. I mean, to go ahead and actually do the merger on paper means you're actually, Denzil, as you know, you drill down into looking at exactly how many employees will remain with the merged company. So you look at every vendor contract, you look at every employee, their base, their compensation, their bonus, et cetera, and you actually merge the company on paper. And it's a real uplift for the owners, because one of these companies that we did that with, the 2 companies was bought, the merger was bought by Wix, and the other one was bought by VF. So we had a strategic buyer on the one hand in the travel market, and Wix was the other company with TMG, and McMurray bought that one. Yeah. And it's gotten a lot of stuff out of the way for the buyer, whether it's a strategic buyer or private equity, because you can actually see on paper how the merged company works. And it really is a very nice value enhancer for the sellers, and particularly 2 companies that are somewhat subscale. Denzil, you asked a good question about scale. Well, in this market, if you can get to 10 million in EBITDA, you're going to get 1 valuation. You can get to 20 on a multiple level. Your multiple probably increases 30-35% for the same business. So if you can actually put these 2 businesses together as a merger on paper and market it, that package that way, then you're going to get a much nicer lift in value.
Yeah, so that really is driving value for the owners, isn't it?
It's very hard to do.
Yeah.
I mean, it takes thousands of hours internally to do it properly. And for those of you that maybe don't know us, Jim knows us. We try to do everything the highest standards.
Sure.
So it's a lot of work to put a merger together on paper and then take it to market.
But it proves out the scale point. I think that's really it.
Well, Wilma's being modest. I'll just add, the gentleman we bought Strategic Insight from was one of the most eccentric people you'll ever want to meet, and how they put up with him for the whole process. But it was a great business.
It was a great business. We left the psychics out.
Well, okay. Well, I'll have to mention that. I will have to tell that story. When we were doing due diligence, and Deloitte did the financial due diligence for us, the gentleman who owned it had used, for forecasting purposes, not only did he not have budgets, but he used psychics to forecast how things were going to go. And he spent $100,000 a year on psychics. So he came to me and he said, you know, if you're not going to give me credit for that, I want to get credit, you know, for EBITDA for it. So I agreed to it. I had to get it through Austin. And when Deloitte did their report, they said, look, we're going to put something in here we've never put in a report ever that we've ever done. And what it was they said for alternative consultants, and then they put in parentheses, psychics. So, as I said, he was out there, but he was the genius behind the product, though. Quite honestly, the one that Denzil found that everybody said, make sure Avi stays with the business. He was smart enough to know that he shouldn't be the face of the business, so he would let this other gentleman, Avi, go out and was everybody's favorite uncle. But he was the one that really developed this fund flow model ahead of anybody else. But he was out there as you'd ever want to get.
Did you ask him if the psychics were right, though?
Yeah.
No,
Hey, he's...
I don't mean to take it down, but this is too good a story. He walked into our offices in June and said, I want to engage you guys. I want to sign the engagement letter today. You know, no one ever does that. And he says, I want the deal done by August or August something.
Right.
Why do you want this deal done by August? He said, because the psychics have told me. So we'll blow up.
Well, it was the 2012, and he was really afraid based on the calendar. He did take the money we gave him, and he moved to Australia where he thought he would be very safe. It's a true story.
And he's safe.
So these things do have kind of twists and turns, and you have to be very patient if you're on the buy side. And but you know, it was worth it. He asked me just before closing if I found him kind of difficult to deal with, and I said, well, you know, Joel, as long as you're selling and we got the same deal, we'll get it done. We did.
Yeah, great story. It'd be tough to follow that, so we'll look for some other. Don't feel intimidated, anyone. It's okay.
Actually, you know, Chuck Richardson back, I've loved some of the things he's done on valuation in terms of the impact that growth has. And I don't know, maybe Chuck, you could just reference that a little bit, how much growth plays into it.
When we threw a lot of data into the discrete statistical model, I spent some time in M&A, so I know it's not statistics, it's all the things you're talking about. Just to see if anything would turn up statistically, it's dramatic how the trailing 12-month growth rate corresponds. They call it or not, but it corresponds with valuation. So to the extent that affects, one of the takeaways I've always had from that is to the extent that you may want to do window dressing on margin at the expense of revenue growth, you may want to balance those because revenue growth plays such a key role, and everybody thinks they can improve margins by firing everybody once they take over the company. And
I think it's a great insight.
the other thing is just don't ride the curve too long because as you get bigger and bigger and your growth rate scales off, it has a very dramatic impact on valuation.
Right. And I think the other point that's worthwhile making here is making sure you leave something on the table for the buyer. You know, leaving runway there. And I try to get my folks, the people I represent, to really think about, you know, put yourself in the buyer's shoes. You're a seller, but put yourself in the buyer's shoes, and would you think about buying this business? And why would you buy this business? And you have to leave some you know, tangible growth strategies that they can execute. You have to give them a list of potential acquisition candidates. You have to give them a great staff. You have to give them some great ideas. You have to make sure all your systems are right. So you've got to be able to sell that too, because if you've taken the business to the mountaintop, and you know, other people will see that and they won't buy it.
You got to leave some gold in the ground.
Absolutely,
the new owner.
Absolutely, and whether it's real or imaginary.
Can you guys talk a little bit about valuations relative to business model types? So, you know, how does the subscription business model sell in terms of valuation against something that's straight advertising?
Sure.
Conferences versus others. That might be helpful.
Yeah, I think, you know, it's tough right now. If you have something that's strictly advertising driven, and we saw this in our own process, people would come in and say, you know, we want to give you one multiple for your data subscription business, and you know, we'd be comfortable with that multiple even being 14 times. You know, that other piece of the business is probably worth 6 or 7. Quite honestly, that approach of some of the parts didn't win. It came down to a private equity firm that valued it all the same, and it was a double-digit multiple on a trailing 12. And it was a strategic company that I think misplayed their hand because they were both tied after round 2, and they didn't think that a PE firm would pay that type of double-digit multiple. But you know, you are going to get, if it's strictly advertising driven, it's going to be more in the 6 to maybe 8 times. And you know, if it's an events driven business primarily, we do about $8 million of events, but it's not enough to really turn that, you're probably maybe in the 8 or 9. Charlie McCurdy's been around. He seems to be the expert on getting a good multiple right now out of those event businesses. But historically, those have traded in that type of range, maybe 8 to 10. I know Wilma sold the business that was close to 10 this year in the events business. And, you know, if it's data and subscriptions, you know, it depends what area, how big it is and things, but you could clearly, if it's growing at the right level and people can see that growth being sustainable, you know, looking at something between 12 and 15 times on a trailing basis in today's market is not unreasonable.
Well, you know, the previous panel hit it right on top of the head. The holy grail now is to be part of the workflow, be part of the desktop, because if you're a part of the workflow, the switching costs are so inconvenient and so expensive for the end user. That multiple is really just, you know, out of sight at this point. I couldn't even guess as to what the multiples are. And I don't even know what multiples are in general now, because you really have to see what the market's gonna respond. So.
Yeah, okay, that's useful. And marketing services that we hear a lot about, where would you put that on the scale?
Well, that's where I'm saying, because at the end of the day, as nice as you package marketing services, a lot of that is driven, that marketing spend, through digital advertising and other things, and you are going to get some buyers, unless they see that the marketing services really accelerates the growth of the other side and they're connected. In our case, the buyer, Genstar, had recently sold the business in the travel area, well, TravelClick, that had that same type of component, data and a marketing solution, and they had a great exit. So they were very comfortable in seeing the two being working well together. A lot of others that came in and looked at it just didn't get that.
Right, and don't be shy about, you know, mixing reoccurring revenue businesses and other things. Martin and I sold a business, sold HC Pro back in 2008, and we had a consulting business. And I always made sure that consulting business wasn't more than 20% of the overall revenues, and it was always a great story that the consultants, the publishing guys could promote the consultants, and the consultants brought back great ideas on products from the field. So that was a story that held together very, very well. And I don't think did it have an adverse effect on our multiples, Martin? Probably not, right? Very complimentary.
Yeah, I wouldn't make consulting too big.
No, I know, but
it's a fool's game.
Well, no, okay.
Until you can say that.
Especially in M&A. There you go. No, we've got a bunch more questions to ask, but why don't we get some more from
you know,
from
Denzil, if I could just add
Sorry.
one thing too. I think one of the things we did in getting ready for this sale, and I'd recommend this to anybody, because anybody who's buying you is not going to want to know the world ended the day they bought it. And you talked about leave some gold in. We put a product planning roadmap in place that went out 24 months, where they could see where the next data products were going to be coming from. And they could test that. They spoke to our clients and, you know, said, okay, Fidelity said they are interested in that. So I think you really do need, it's not only what you did yesterday, but what you're going to do for the next 24 months, because nobody wants to buy something at a high multiple and just see, that's it, it stops.
Yeah. Okay, any other questions? Oh, we've got one here.
Are there certain market verticals that pay better? You know, like healthcare, for instance?
Sure. Yeah, I mean, and that varies by cycle. I mean, I think, Bruce, you'd be better to respond on healthcare. But
well, I think healthcare, there was a revenue cyclic business that we took a look at that was going out at they were expecting 17.5 times EBITDA, which was, I just shocked at that level. Obviously, we didn't buy it, but, you know, I think healthcare, because of all the things that are going on there, all the dramatic changes that are going on there, is still an incredibly hot spot. And, you know, I'm representing a couple people right now in that spot. And I think there's some just great opportunities. The world is changing so fast there. They were so archaic in terms of how they process stuff. The emergence of the electronic medical record, the stimulus that really just forced all the providers into adopting electronic medical records is just going to change everything in there.
And I think categories like energy has been an area right now. Drilling Info, which Insight Ventures ended up buying a couple of years ago down in Austin. That went for a very high multiple at the time because of the whole shale oil revolution. Financial services, when we were buying, was out of favor. Today, you've seen the strategics return, and it's pretty competitive now.
Yeah. And I would have thought there was markets like banking that would have been wouldn't have been so hot, but there was a transaction, Sheshanov, that got sold a couple of years. Part of Thompson went for a very nice multiple, which surprised me. You know,
Part of a larger package too.
Yeah.
So we're looking at the fundamentals of these served markets.
Right. Well, it's that they have the funding, that they are economically in good shape, and that's sort of, I've got 30 questions, 30 things that you'll sort of look at an acquisition, and you say, what is the shape of the customer? Where are they economically, and where in the economic cycle? How is regulation affecting them? How is the economy affecting them? How is international transaction affecting them? You've got to think all that through.
Yeah. Okay, another thing about maximizing value, of course, is having the right advisors, and the banker's going to be at the heart of that, choosing the right banker. A business that I was non-exec on, we had 3 bankers came in and give pitches, and it was just extraordinary how different they were. You would have thought they'd all come from a different planet. There's also a dear friend of mine, when he came to selling a business, he knew quite a number of the bankers in the market here, and played golf very regularly with one. Another set of bankers would actually not do golf, but actually go and see them every 3 months or 6 months and ask how the business was going, and others they meet at cocktail parties. And the guy who did the golf was shocked that he didn't get the mandate, and was sort of in tears and get upset and all the rest of it. And the question is, well, why? Well, these other guys actually were interested in the business, not just my golf game. So I think there are a few messages I can pick up.
Very true.
How do we see it when choosing a... Let's start with Jim first, and then we'll come to you, Bruce. How do you see this?
Well, you have a board, and so, everybody on the board's an investor. So, you really need to build a consensus. And it's not easy. It depends on what type of business you're selling. Is it one that has a big global component? So is it important that they have a presence somewhere outside the U.S.? So you really look at a lot of different criteria, and it's never an easy process, because I think, we're very fortunate, both, particularly in New York and London. We have some great bankers, and, they really understand how to take a company to market. So those are tough decisions.
Well, I think it's important you find somebody you feel comfortable with, and I would really drill them on making sure they have the time for you too. That's, what you don't want to do is play second fiddle with somebody else in the marketplace, and I think that's just, you just need their time, you need their attention, and I would try to get somebody in the space. I think that's a mistake that a lot of people make. I see a lot of media books from people that just don't know the space, and I just scratch my head and say, I wonder why they didn't hire, one of the usual suspects, one of which is obviously a woman. So, why'd you hire those guys? You should have hired somebody that really knows the space.
Yeah, and I think you made a very important point of who's going to be there at midnight, able to answer the call when there's a problem, versus they're not available or it's only a day.
And who's going to go through a year process? The HC Pro experience is we did HC Pro through 2007, and the credit markets slowly cratered throughout 2007. So we ended up having an LOI with one private equity firm, and that fell through. Then we had another LOI, and we finally closed the third one. But to have somebody that's willing to work with you for that period and stand with you and just get the deal done, it's very important. Yeah.
Okay, so to maximize value, is there anything that you can do to maximize value when you're choosing what type of audience you're going to go to, whether it's going to be private equity or whether it's going to be strategics? Or there's also just one person mentioned to me, said how fed up they were with private equity, and said, I just want to get to the scale where I can just operate in the bond market. So I get 100 million revenues, certain level of EBITDA, I can start playing in the bond market. So I don't have to deal with private equity anymore. That's one person's opinion.
That has its own set of headaches. So.
I'm sure it does. Is there any difference?
I'm going to let you start this one.
Yeah, I think, in looking at it, just being realistic about it today, up until the last 12 months, for some reason, the large strategics seem to sit on the sideline, whether it was Reed Elsevier, Thomson Reuters. Today, that's changed in the last 12 months. But I think coming out of the Great Recession, I would have thought they would have been back in the game sooner, and for some reason, it took them a while to come back. Having said that, if you look at the number of teasers you can send out, and it's a good measure. Let's say you send out 75 teasers. I would venture that at least 50 to 60 of those are going to go to private equity firms that have an interest in the space, and the balance are going to go to strategics. So the odds are that there are going to be more private equity firms in that mix in an auction
But if
process.
there's 75 private equity firms who've got an interest in the space, there's only going to be a
No, I
couple
said
of...
50 out of the 75.
Oh, sorry, 50.
And I said, you know,
Yeah.
maybe you have 20
Right,
to
okay.
25 strategics.
But I'm going to say only a dozen or two of those really know it well. And the others have had some junior analysts kind of have a look at it and they think it's
Yeah,
good.
well,
Aren't they the great guys to buy? Because they don't really understand it and they might come up with a bigger check?
You'd like them to understand it. You definitely want a partner when you go, if you're staying. Well,
that's another issue.
If you're allowed to exit, I might not give you the same answer. But if you're staying, you really do want somebody that understands the business. And, you know, whether or not they've been in the exact same sector, but at least have some understandings of how our businesses work. But the odds are, if you go through that, and let's say you're down to 20 first-round bids, you know, I'd venture that at least 15 of those are going to be private equity firms, and maybe 5 will be strategics. And, you know, you think about it, our industry has several big, large strategic firms, a lot of them represented here at, you know, the SIA Content Group, which is now merged with ABM. And we have a lot more companies, but most of those companies, if you go around the room, are either family-owned or private equity-backed. There's been a shift that took place.
Jim, do you think that math is still right, given the fact that, you know, I've sort of looked at the, you know, I always looked at the attendee list here, and, you know, you had one lender, one private equity firm, maybe 2, but
well, they haven't come as much to the events, but they do show up when, if Wilma sends out a teaser, trust me, she's going to see a lot of private equity interest. They're a big factor. It's, you know, hard to avoid. And you know, I think, in all honesty, again, I've been back with them now for, you know, close to 8 years. You know, these are not private equity firms that go in and tear a place apart. A lot of them identify themselves as growth equity players. So they're thesis driven. They want to invest in growth. They're not looking to just come in and take a large company, rip it apart, and financially engineer a return. Because I don't think our industry is really that type of business. There might have been a couple, you know, Reed Business might have been one you could have done that with, and a couple looked at it that way. But I think by and large, most of the players that look at this space are looking for growth opportunities and where they can invest, although what they said on the earlier panel, invest in the first 24 to 30 months and then start getting it ready. They're not somebody who's going to sit in the business for 10 years.
Right. One would argue for the first 6 months it's a honeymoon, and then you only have 18 months to really buy them, because then you get ready for it.
You could argue that.
Yeah.
Yeah. Okay. Any other questions? Okay, well, let's just move, as you all think of the questions where I name you and force you to come up with one, let's just move to that point about being both a buyer and a seller. And Jim, you just alluded to that.
Yeah, I
and
mean,
we're trying to maximize value, but at the same time, you're kind of selling to yourself.
Well, we were just sold, but there were deals we were working on, you know, prior to that Jason had contacted some of them, you know, several years earlier. And that was one part of the sale process. People wanted to know what the pipeline for buying looked like. And so there were some, at the day we closed, we were told, go get them. And so basically we've re-engaged with several of these companies, and, you know, are now looking to enter into LOIs with 2 of them this week to actually buy, one in Germany and one in London. But, you know, you have to, it's just like the product question you asked earlier, Denzil. You have to have, you know, something left for the growth, and you have to show your cards about what's out there to buy. Because one of the questions a lot of the PE firms have is, well, if you've maximized this and it's all organic from here, you know, am I really going to get the growth rate and the return? Can I invest as much as I want? So, you know, I would say it's very helpful to have somebody like Jason, who's spent a long time in the strategy and development area and understands how to go out and can cast a wide net and talk with bankers about opportunities. So we never stopped looking, even though we were going to be a seller. So I think that's very important.
Yeah.
Well, on the, you know, representing both the buyer and seller, I did it twice at AC Pro. When I did the management buyout, I bought it from the founders. But I was also an equity player, so I was representing both sides. And then when I sold it in 2008, I rolled over my equity, so I was representing both sides. It's a tricky day. You do go home every once in a while and scratch your head and say, who am I working for? But the whole thing is really trying to be fair to everybody involved. And you can get through it. It happens and it works. So.
And then how much do you think about the business after sale. We're talking here about maximizing the value. But then after the deal's done,
well,
you're thinking then about the next phase. And
well, it depends. It depends who you sell to. If you're a strategic, and they're going to keep you or not keep you. So and that business could stay in a strategic for forever. Or a private equity is you're back to the 5 or 7 years, or you can get one of these family offices that are kind of interesting and they have a longer horizon, and you might that. But be very, very comfortable with who you buy. You really. Brent talked about the red wine at Gibson's. You should do several red wine dinners at Gibson's, and make sure that you feel comfortable with these with whoever is buying you, because you're gonna be with them for a while.
I think the family office is a really interesting one. Gil, you worked with a family office for a number of years. How would you characterize family office ownership?
Well, it can be a much longer investment horizon. They don't have a need to sell to anybody, and that can be very positive for a business. And they're becoming an increasing player in the M&A market. They have a difficult time generally keeping up with these auction processes. They're not staffed that way. They're not used to it. So that tends to make them less a factor.
Define family office.
You're often dealing with very idiosyncratic people who made a lot of money, who think they know the answer, and they'll sometimes be a less professionalized environment than an institutional buyer. But there are wonderful things about that as well. And the loyalty.
Yeah, exactly. Just about to ask. Yeah.
It's a mixed bag, but it's definitely an option.
Okay. Any other questions before we ramble on? Because we want to be able to deal with people's concerns or thoughts. No, it looks like we pretty much nailed it. So in that case, Jim, can I just talk to you a little bit more then about the conflict which you feel when you're staying in the business yourself and you're doing?
I mean, when you went from
deal.
being the seller to now you're running it for the new owner. So.
Yeah, that's right. And during the time of the deal, because I'll give the background to that. We're working on one deal at the moment where the forecasts are so conservative. There was a massive row between the investment bank and the sellers, and this business will go for about $300 million. So it's a decent sized business. And the management were just always putting in contingencies, keeping the forecast down, because they know that in the new world that they're going to have to hit some numbers and so on. And we witnessed some quite interesting discussions.
That conflict is there, and it's very difficult to deal with. And it's also, you get into even, I'll give you the other side of that too, with a strategic. The strategic that was looking at us was very clear. They had no interest in growth through acquisition. We were there. We were going to fix a problem they had with a large division, and that was it. And, a couple of the members of my team clearly had a hard time with that, and I'd have to advise them, look, if they're the high bidder by a significant margin, they're going to get this business. And they would say, well, I don't want to stay with it. And I understand there's going to be some of you that they're going to insist would have to stay. In my own case, their first bid said 18 months, and then their final bid said 36, which I had a problem with, to be honest, on my own end of it.
Yeah.
I was not looking to just manage a division, again, more or less back in a Reed Elsevier type environment that I had felt that I had done and had left for certain reasons. But, at the end of the day, even though my agreement with Austin Ventures said I could have left when they left, and the same with the current buyer, if you want to get a deal done and that's the requirement, you'll stay and do it. But so some of your team sometimes feels conflicted, your senior management team too. They kind of favor one buyer because they think it's going to be more friendly to continue growing the business to another who, has their own plans for it. But I think, once you've taken in the initial money from private equity and they're the majority owner, in our case, Austin Ventures owned 70%, management owned a little over 30%, it was clear who was going to make a final decision on that. Within reason, I think Ken and Phil would have, said, okay, we'll go that way if your team feels that way, because you got to deliver a team that's happy and willing to go to work. At the same time, if there was a wide gap, they would have had to do the right things for their limited.
And what about earnouts as a way to maximize value? I saw some reference to that in the last panel. Is that a way in which we think value can be maximized, or is it just a way to make lawyers rich, or because we couldn't really come to a sensible deal and it's a cop-out?
Well, they're very difficult to negotiate, clearly. But if you are buying entrepreneurial talent and you want them to stick around, then that's a way to do it. It gives them, you can do it on revenues, you can do it on EBITDA, you can do it on EBITDA without corporate allocations, you can do it on all sorts of different formulas that allows you to at least keep some chain on that entrepreneur, founder, or some special people on the management team.
But won't they always lead to renegotiation? Won't they always lead to an argument over investments?
Nope. I would say sometimes they do, but not always. I've seen them about 50% work out without a discussion, and I've seen 50% fights.
If you could do a deal without one, I'd recommend it. But,
absolutely.
As Bruce said, we use them where we have to in the deals when we buy. So
somebody, I forget who the previous panel said, the important thing was their brands, their assets, and their customer list. And I said I was waiting for them to use the P word, people, and how important. And I was waiting for that word to come out, and it didn't come out. And I said, well, yeah, you're people, and it's really, this is all a people business. This isn't really, you have brands and you have systems and all that good stuff, but it's really the people that generate it, and you've got to keep them in place and keep them informed and be completely transparent with the process. I see these people I see sellers, tiptoeing around because they don't want to tell their staff that they're selling the business. And I think that's absolute nonsense. I think you've got to be absolutely clear, because you don't want them finding out through all the different channels that are out there.
And they will.
And they will. They always do. They always do. This world talks.
You can't hide a sale process. Yeah. You're absolutely right.
And you just got to be completely transparent about the process. And trust me, they appreciate it. They really appreciate it.
You touch on one thing too that's important. In our case, we had roughly 30 people that had stock options. So this global senior management team out of about 225 employees at the time felt invested in this.
Okay.
So we're supportive of that process. And today, Genstar tended to want to keep, in their mind, down around 15, but we've actually negotiated. We didn't cut people out. We're back. We have actually 32 people now, post-transaction, that have new stock options with the Genstar transaction. I think Bruce touched on a key point. Your key management team needs to be supportive of that process, and to be supportive of it, they have to feel like there's something in it for them besides the job.
Right.
So we were not a Silicon Valley type play that we touched everybody, but we did feel the need to touch a fairly good percentage of the key players on a global basis.
And I think when you have 300 or 400 employees, you don't have a choice. You can't. There's only so many things you can do when you walk into your office as a CEO to do that, and you've got to make sure that they're all buy in. And both rounds of HC Pro had over 20 or 25 equity participants, employee participants.
Yeah, that's great.
So that's one of the really important things that's come out right at the end to drive values, to make sure that you've actually got the motivated team.
And trust me, 15 of those people came right out of my pocket. So, but I thought it was necessary.
Mm-hmm.